Welcome to the Deep Dive. Today we're digging into the Q3 2025 earnings call for American Tower, ticker AMT. That call happened back on October 20th.
Yeah, and our job today is really to unpack something puzzling for you. AMT put up some great numbers, operationally speaking, beat estimates, raised guidance.
The whole package.
Exactly. But the market, it didn't like it. The stock actually closed down pretty significantly, about 3.7%. So what gives? Why did the market seem to ignore the good news?
Let's lay out those headline numbers first, the ones that sort of set up this whole contradiction. I mean, if you just look at operations, AMT really did hit it out of the park.
Huh.
The big metric for these tower companies, these REITs, is AFFO per share, right? Adjusted funds from operations.
That's the one. It's basically the key cash flow number we watch.
Yeah.
And it came in strong at $2.78 per share. That beat the street's estimates by, what, $2.12 and 14 cents?
Which is a pretty solid beat, not insignificant.
Not at all. And revenue was right there with it. Total revenue hit $2.717 billion. That's up 7.7% compared to last year.
Okay. And that strength carried through.
Straight down the line. Adjusted EBITDA, that's earnings before interest, taxes, depreciation, amortization, came in at $1.816 billion, up 7.6%. Net income was solid too, $913 million, which works out to 1.82 cents per share. I mean, look, operationally, it was just clean, a win.
So, okay, they beat on everything. They raised their guidance for the year, and the stock gets hammered. Down 3.7% on what? Double the usual trading volume. It's a lot of selling.
Yeah, big volume.
So why should you, listening right now, buy into the company story when the market's obviously voting with its feet, at least on that day?
Well, I think the first piece of evidence is that raised outlook. Management didn't just stand pat. They significantly boosted the full year 2025 forecast. Key metrics like property revenue, adjusted EBITDA, and that AFFO per share.
That AFFO number, what's the new range?
They're now projecting at the midpoint somewhere between $10.60 and $10.72 per share for the full year. And they said this raise was helped by better foreign exchange rates and also their U.S. service business doing better than expected.
And the underlying growth, the organic growth story, that seems to be getting, let's say, clearer now.
Yeah, consolidated organic tenant billings growth. So that's growth from existing towers, not acquisitions, was a solid 5.0%. But the really interesting part was in the U.S. and Canada.
Right, they flagged something important there.
Super important. Okay, so the reported organic growth for U.S. and Canada was around 4%. But, and this is key, if you strip out the impact of Sprint churn.
That's the revenue they're losing as T-Mobile takes down old Sprint sites.
Exactly. If you take that out, the underlying growth was actually over 5%. And the big news, management said Q3 was the final quarter. They'll see that specific Sprint churn impact hitting the numbers.
Okay, that is a big deal. It means going forward, that headwind is gone. We get a cleaner look at the real U.S. growth starting now, basically.
Precisely. It gives much better visibility. And internationally, things are looking strong too. Nearly 7% organic growth overall outside the U.S. Africa and APAC, the Asia-Pacific region, both showed double-digit growth.
So that strategy of investing in those sort of higher growth markets seems to be working out.
Yeah, it really does seem to be paying off.
Okay, let's talk foundations. The core demand driver for towers is just people using more data on their phones, right?
Yeah.
What's the latest there?
It's still a tidal wave. Management mentioned U.S. mobile data use jumped about 35% year over year, and that's for the third year running. Think of that. It implies network capacity basically needs to double every 2 or 3 years.
Wow.
That pressure is constant. It forces carriers to keep spending, keep upgrading.
And we hear a lot about 5G rollout. They said something like 75% of their U.S. towers now have 5G upgrades. Does that mean things slow down now?
Not really, no. It signals a shift. We're moving from just getting broad 5G coverage out there to densification.
Densification, meaning adding more antennas closer together.
Exactly. Think of it like adding more lanes to a highway in the busiest spots, not just making the highway longer. That need for density, especially in urban areas, drives the next wave of spending. That's good for AMT.
And what about things like satellite internet, Starlink, and others? Is that a threat?
Management seems pretty clear on that. They view satellite as complementary, good for very remote areas where towers don't make sense. But for handling the massive data capacity needed in most places, they don't see it as a real competitor to their terrestrial towers.
Okay, let's shift gears away from the traditional towers to CoreSite, their data center business. This is supposed to be their big play on the AI boom, right? How's that looking?
It's looking strong. Data center property revenue grew over 14% year over year, and they actually had a record quarter for new retail leasing revenue.
So demand is picking up.
Definitely. It's driven by the usual suspects, hybrid cloud, multi-cloud setups. But now you're really seeing those early AI workloads move in. Things like AI inferencing, machine learning training, GPU as a service providers needing space.
What makes CoreSite specifically good for AI? Is it just data center space, or is there something more?
It's about the type of space. High-density compute. These AI servers need huge amounts of power, specialized cooling.
Like liquid cooling.
Yeah, they specifically mentioned liquid cooling capabilities, plus really robust network interconnections, which are vital for moving massive AI datasets around. It's these features that make them confident they can achieve those mid-teens or even higher stabilized yields on these investments.
Higher returns than the tower business, basically.
That's the argument, yes. They're positioning CoreSite as a premium asset class.
Got it. And there was a point about pre-leasing share dipping slightly. Did they explain that?
They did. They said, look, it wasn't a drop in demand, it was just timing. As projects they had pre-leased got finished and moved into the in-service category, the percentage labeled pre-leased naturally went down. The actual pipeline of deals remains very strong.
Okay, good clarification. Let's talk money management. Financial discipline. Leverage is always a big topic for REITs, given how much capital they need.
Huge topic. And they had good news there. Management highlighted they're focused on keeping the balance sheet strong. Net leverage, that's their debt, relative to earnings, actually dropped to 4.9 times.
And that's low compared to others.
Yep, they stated it's the lowest among their tower peers. And for you, the listener, hitting this lower leverage target is maybe the biggest internal catalyst. Why? Because it frees up cash flow.
Cash flow they can use for, well, other things now.
Exactly. And they've already shown their hand a bit. They bought back $28 million worth of their own stock after the quarter ended.
Using that big $2 billion buyback authorization they have.
Precisely. That authorization is now kind of unlocked, you could say, because they hit their leverage goal. They also confirmed about $1.7 billion in capital spending, CapEx, for the year, with most of it, like 80%, going to developed markets like the US and Europe, and importantly, to CoreSite, high return areas.
Okay, before we get to the wider market view, we have to touch on the legal stuff. There were a couple of disputes mentioned that might be spooking investors. First, AT&T in Mexico.
Right. This one's a bit complex. It's about how tower rent is calculated under a specific contract down there. AMT had to set aside, or reserve, about $20 million in revenue in Q3 because of this dispute. That brings the total reserve for the year to $30 million.
Do they think they'll win?
Management says they expect to win when it goes to arbitration, but that's not scheduled until August 2026. So it creates this sort of known, relatively small drag on revenue for a while.
Okay, manageable maybe, but then there's the Digash network situation here in the US. That seems potentially bigger.
Potentially, yes. Dish Air told AMP that they believe a recent spectrum sale they did excuses them from paying rent under their big master lease agreement, the MLA.
And AMT says?
AMT strongly disagrees. They've filed a legal action asking a court to confirm that the contract is valid and enforceable all the way through 2036. Now, this DHH contract is about 2% of AMT's total property revenue, so it's not huge, and it's not tiny either.
Is DHH actually paying right now?
Crucially, yes. DSH is currently paying their bills. That's why AMT hasn't taken any revenue reserves yet, unlike the Mexico situation. But it definitely creates this legal uncertainty hanging over that chunk of revenue.
Right. So, okay, bring it all together. Management's hitting its operational targets. Organic growth looks cleaner now that Sprint churn is ending. Leverage is down. Why does the market focus on these couple of legal issues and, I guess, wider macro fears enough to knock the stock down nearly 4% after such a good report?
Okay, this is where we have to talk about the REIT structure again and the cost of money, basically. What we saw is kind of a classic great company, tough neighborhood situation. Bullish fundamentals, but a cautious market overall, what some call a cautious tape.
And being a REIT makes them extra sensitive.
It does. AMT needs a lot of capital. They carry significant debt to build and buy all those towers and data centers. When interest rates go up, like they have, the cost of borrowing that money goes up. It makes their future growth projects look a bit less profitable in comparison.
So it's not just AMT, it's the whole sector feeling that pressure.
Exactly. Plus, investors compare the dividend yield they get from a REIT like AMT to what they can get from super safe government bonds, like T-bills. If T-bills are offering a decent yield with no risk,
then investors demand a bigger discount or a lower price on the REIT stock to compensate for the extra risk.
You got it. So The market right now seems laser focused on interest rates and that cost of capital issue, and it's kind of overshadowing the positive story about 5G growth and the AI demand driving CoreSite.
So what catalysts could change that narrative? What should we be watching for that might force the market to pay attention to the underlying business again?
Well, number one is continued strong results from CoreSite. More big lease signings, especially ones that show they have pricing power because of that AI demand, that would be huge.
Okay.
Also, watching the carriers, seeing them actually spend on deploying those new 5G and maybe even early 6G spectrum bands, the high frequency stuff, that proves the densification cycle is real.
Makes sense.
And obviously the big macro one. Any clear sign from the Fed or other central banks that interest rates have peaked and might start coming down, that would lift a major weight off the entire REIT sector, including AMT.
All right, let's pivot to our This Is Not Financial Advice segment.
Okay, so let's just sum up the setup again. You've got strong operational performance, beats on earnings, raised guidance. You've got these huge secular demand trends, 5G needing more density, AI needing specialized data centers, and you've got the company hitting its leverage target, now the lowest among peers at 4.9x. All that. Versus a stock price that got knocked down. Seems like a mismatch, right?
Yeah, a clear valuation gap seems to have opened up. So what's an outrageous but plausible trade idea based on that? Something that uses the company's own actions as a potential trigger.
All right, here's the pitch. Go long AMT. But structure the thinking around capturing the impact of share buybacks. They have that huge $2 billion repurchase authorization ready to go.
And they can use it now because they hit the leverage goal.
Exactly. The constraint is off. So the idea is that management, seeing this disconnect between operations and stock price, starts using that $2 billion aggressively to buy back shares.
Signaling they think the stock is cheap.
Right. It's a direct signal. And mechanically, buying back shares reduces the share count, which automatically boosts AFFO per share. It also provides support for the stock price. So the bet is that these buybacks act as a catalyst to stabilize the stock's valuation, maybe even push it higher, regardless of what happens with general REIT sentiment or interest rates in the very near term.
It's basically betting on management using its own financial firepower to close that gap, an internal catalyst.
That's the idea. A fundamental bet on a team with the means and the motive to address what they likely see as an undervaluation.
Okay, let's wrap this up. The key takeaway for you, the listener. American Tower seems to be executing really well. They're riding these two big waves, the need for more 5G density and the rise of AI fueling data center demand via CoreSite.
But because it's structured as a REIT, the stock is currently getting weighed down by the broader macro picture, especially interest rate concerns. That negative environment is kind of masking the underlying operational strengths right now.
The growth is there, the balance sheet looks better, guidance is up.
Yep. So here's a final thought for you to chew on. We know CoreSite demand is accelerating. We know management teased they'll talk more about cutting costs and improving efficiency on their next call, the Q4 outlook. So the question is, how fast can they really scale up that data center capacity? And how well can they integrate everything to drive even better margins? Can they do it well enough, quickly enough to finally make AMT stock trade more on its own merits and less like just another REIT getting pushed around by macro forces?